E-mini, the buy climax just keeps going up and up and up. I think the weekly chart from a couple of weeks ago is important. We have the two biggest bull bars late in the bull trend. Usually that is an exhaustive end of the trend. Sometimes you get a pause for a few bars and then one more buy climax and then the trend ends. But this is a sign that the trend has either ended or will end sometime in the next 4 weeks or so. When a buy climax ends, it does not become a bear trend. Sometimes it does. Usually it tests down to the bottom of the most recent buy climax. This whole thing is a buy climax. And then we have an extreme buy climax here. And the first target is the bottom of the final buy climax. And then the market usually goes sideways. Therefore, it'll take a few weeks to get down here, and we'll probably go sideways for a few weeks after that. That means that the next couple months, next 2 or 3 months, probably will be mostly sideways, even though we're in a parabolic rally at this point. We ended Friday with a wedge here. Odds are 2 legs sideways to down. We have 1 leg, pull back 2. And the 60-minute chart also has a wedge. 1, 2, 3. Not a good sell signal bar, the final hour of Friday, but we're probably going to start to pull back either in the first hour or so, or maybe we'll go up a little bit more and get a better sell signal bar and then pull back. The target is the bottom of the wedge here. First target is this major lower high. So about a 20-point pullback here, 40-point pullback here. And if it does get down here, the bears would hope to get a measured move down. Takes us down to around 2,700 and the start of the year. I think this is more important. This is the top of the trading range, the breakout point. But I think this price is more important because that is the open of the year. And last year, the market did something unusual. It rallied from the open of the year and never came back and tested the open. That's unusual. Normally, the market comes back and tests the open of the year at some point. And this is the open of the year, so we'll probably test it at some point in the next couple of months. The reason why bulls keep buying up here is whenever the market's in a strong bull trend, for example, weekly chart, they just keep buying. Monthly chart, they just keep buying because they know that a bear trend is very unlikely when a rally is this strong. So they buy hoping it goes higher and they can make money, but they're confident that if instead it goes lower, the sell-off will be a bull flag or a bull leg in a trading range. In either case, it'll come back up to this price, their final buy. So they buy here, they buy more low here, lower here, knowing that if it does get back up here and we're in a trading range, they can exit and they'll have a profit on their second entry and they'll get out break even on their first. And that's why the market's going up, because traders have no fear of the downside. They know that even if we fall 10%, we're still going to come back up here several months later. Bulls want this to be a double bottom bull flag, but a pretty obvious wedge top. And therefore, if we do break above Friday's high and get above the top of the wedge, probably, I would say, better than 50-50 chance there'll be sellers above and that the bull breakout above the wedge will fail. The bears are hoping the 5-minute wedge begins to reverse now. So first leg down, pull back to a lower high, and then second leg down. But to sell, the bears need a decent sell signal bar. For the bulls, this is a double bottom bull flag in a bull trend. But I think a lot of bulls are not going to buy above 1 because they see the wedge on the 5-minute chart, they see the wedge on the 60-minute chart, and they see last week was a doji bar, and they see we also had 2 bear bars, 1 and 2 on the daily chart, which is This daily chart is that 60-minute wedge. First leg down, that's this bar. And then second leg down, that's this bar on the daily chart. While I think we're going to be sideways for the next 2 or 3 days because of the 60-minute wedge top, not a lot of traders are going to sell above one. We have a 5-minute wedge, 2 legs sideways to down likely, 1 pullback 2. We're in a bull trend on the 5-minute chart, 60-minute chart, daily chart, weekly chart, monthly chart. Not a lot of traders want to sell at the high of a bull bar closing above the moving average, even though we're probably going to pull back for 2 or 3 days after the 60-minute wedge top and all of the buy climaxes. I think the market is deciding, do we get one more new high above the 5-minute wedge top and then the pullback, or do we get the pullback from below last week's high, which is the top of the 5-minute wedge? Most traders should wait right here. Four sideways bars, possibly a triangle. Pretty quiet day Friday. We had a breakout here for a few bars, but most of the day was sideways. All of that increases the chances of a trading range open today. Plus, we're opening in the middle of this trading range at the end of Friday, right around Friday's close. Past 2 days, we're mostly sideways. We had rally here, but we had legs down as well. And we're opening within the range of the past 2 days. We're at the top of it, but we're still within it. And we're not getting consecutive big bull bars closing on their highs. While we're always in long, what we have so far looks very similar to what we've had for the past 2 days. That increases the chances that today will be another day that will be mostly sideways. Swing trading right here. Can you buy above 1 for a swing? Possible low of the day. Sell below 4 for a swing? Possible high of the day. We've been in a pretty tight range for 10 bars. I think most traders taking trades here are only looking to scalp. Selling above 2, a bear bar, is better than selling above 1, a bull bar, and a bull trend. But I think a lot of traders are just waiting. This is a pretty tight range. It's like trading in here. Very difficult to make money. Reward is small, risk is relatively big, and probability is around 50%. Bulls want to get a successful breakout above the wedge top, and the bears want a lower high. Or if we do go above yesterday's high, they want a failed breakout above yesterday's high and an early high of the day. Since today's probably going to be mostly sideways and we're near the top of the 2-day range, it increases the chances that whatever rally we get will fail and we'll put in an early high of the day. What happens if we start to get 2 or 3 big bull bars? Then everyone will have concluded that instead of a top, we're going to get a measured move up. For the bears, a lower high, but 5-bar bull micro channel, more likely buyers below. A rally, but not strong. The bulls want to break strongly above Friday's high, the 5-minute wedge top. 60-minute has a wedge top, but no good sell signal bar, so not a lot of bears short yet. We haven't traded below the low of a possible sell signal bar like last hour. Always in long, not much downside risk after a 5-bar bull microchannel. But location is bad at the top of a nested wedge and no strong breakout. So a lot of bulls, if they're buying, are buying small, thinking that we could form an opening trading range and they want to buy more lower. This is what I was talking about, that there might be more sellers than buyers at the top of the wedge. Now, 6-bar bull micro channel. Not a lot of stop entry bears willing to sell below the low of the prior bar. So probably more buyers than sellers below 6. But you can see some limit order sellers at yesterday's high, some bulls taking partial profits. Some bears might be scalping. Where the chances that it could go straight down? Small. 6-bar bull microchannel, even though the rally lacks consecutive big bull bars. It's still 6 bull bars or 6 bars up. And that is a sign of persistent buying, even if the buying is not strong, even if we're not breaking strongly to the upside. Suppose we get a big bear bar closing on its low. Well, even then, the odds still are more sideways than down. It would be a possible high of the day, fail breakout yesterday's high, but not a high probability sell. Weak rally, limit order bears selling yesterday's high probably will make money, but they'll probably scalp, which means not a lot of downside. 6-bar, 7-bar bull microchannel, probably buyers below. Looks like a bull leg and a trading range, so we might pull back deeply, but most bears will not swing a short unless we go sideways more first. Limit order bears made their money selling yesterday's high. While it's possible that this is the high of the day, more likely it's a minor reversal after a 7-bar bull microchannel. So more likely buyers down here than sellers. Possibly sideways here because a lot of the bulls who bought the 7 low will scalp, which means they'll sell 4 ticks above. A lot of the bulls scalped out, but some bulls are holding, hoping that we have a trend from the open bull trend. I was not willing to hold, taking a chance on the breakout. So now I have to decide what to do. I'm hesitant to buy the breakout. So I'm going to wait to see what we get. Yesterday, breakout here, reverse, breakout down, reversed up. Weekly chart, last week was a doji. So a pause after 2 big weeks up. That reduces the chances that this week will be another big week up. And that means this week probably will not have a big bull body. That means it'll probably have a small bull body or possibly a bear body. Since we're above the open right now of the week, we're probably not going a lot higher. It's possible we could get another big bar like this, but I think more likely we'll probably get another small body, even if we rally first. Sometimes you get a tail down and then a tail up. That's a pretty common occurrence. Top of a channel, a pretty good breakout. Most bears are not going to sell below 9 unless it's a reasonably strong bear bar. 2 or 3, 4 tick bear body closing on its low. 8 is a surprise. It was more likely that we were going to go sideways and start to form a tight trading range. Instead, we get a big bull bar. When you get a surprise, the odds are you're going to get at least a small second leg up, and that means unless 8 is an exceptionally bearish bar, probably will go at least a little higher. By the close, if traders are able to buy more lower. Bears had a potential 60-minute wedge top. Right now, the bulls are getting a breakout above. The wedge is 40 points tall. A measured move up would take us to around 28.60. Bears still hoping this breakout fails. For the Bears, we broke above yesterday's high 6 and failed 7. And this is a second entry failure, but 8 is big enough so that I think you start the count over again. Therefore, selling below 10, arguing second failed breakout, yesterday's high. I think not many computers are going to make that conclusion. They'll say this is a first reversal down. This is strong enough so that we'll probably get at least one more push up. Low probability short below 10. I don't care what the bar looks like. I'm not going to sell below it. If we get 3 consecutive bear bars, then I'll think about selling. If it's a bear bar closing on its low, maybe 1 tick tail, I would not buy below it. I would wait to see if we get 2 or 3 bear bars. Even if it has a 2 tick tail, I'm not going to be buying at the low of the bar. Getting near the end of the first hour, bulls are getting a breakout above an attempt at a wedge top. The bears still want the breakout to fail. When a breakout bar is big, it increases the chances that it's going to be successful. Sometimes when you get a rally for the first hour, hour and a half, the market then goes in a tight trading range for the remainder of the day. Not a very clear parabolic wedge. 1, maybe 2, and 3. And the less clear a pattern is, the fewer computers will trade it. And because this is not a good looking parabolic wedge, not a lot of traders, not a lot of computers are going to sell below 11. Phillips chart around a measured move up. But the momentum up is so strong, not a very good sell until there's at least a micro double top. Can you sell and take a chance it's going to be the high of the day? I would not. I would wait until there's at least a micro double top or several consecutive bear bars. High one buy, but a bear bar after a buy climax. So a lower probability buy above 11. But I'm not sure that it's worth shorting the 11 high when a breakout is as strong as this is. Do the always in bulls get out below 11? I would not. I would get out below a bear bar closing on its low, maybe, but I would not get out yet. If they get 3 consecutive bear bars with 1 or 2 of them closing on the low, maybe get out of longs. High bull flag. Breakout mode, it's usually a triangle on a smaller time frame chart. But I think a low probability sell up below, or especially below, and probably even above is probably not worth selling. Bar 12 is the end of the first hour, and the bulls have a breakout. They'd like to get follow-through buying on the second hour. The bears look at this bar and say it's the biggest bull bar in probably 50, 60, 70 bars. And therefore, there's an increased risk that it is an exhaustive buy climax and a failed breakout above the wedge. The next thing I'm looking at is whether or not the bears will get 3 consecutive bear bars, and whether they'll make money selling on a stop below 12, which I think they will not. If the bears start to do things, then this is possibly an early high of the day. Right now, more likely, we're going to enter a tight trading range. High one bull flag, doji bar. So bulls not enthusiastic to buy above 13. They probably bought below 12, bought below 11. The bears know that we might be entering a tight trading range. Some bears would sell 13 high, 10 high. I would still wait before selling. You can see it went 5 ticks above 12 low and paused. So it tells you some of the bulls are scalping at least part. I'm going to open my examples PowerPoint. Trying to remember where I put this. What I was looking for is a day where you have an early breakout and then a tight trading range for the rest of the day. The market, therefore, is in breakout mode for trend resumption up or trend reversal down, but the breakout does not come until the next day. That's what sometimes happens when you get these early breakouts. Still always in long, still no credible top. But we might be entering a tight trading range that could last all day. Right now, the odds still favor higher prices, maybe a parabolic wedge with one more push up. Usually, if you're getting a parabolic wedge top, the pullback after the second leg is only a bar or two. This is 5 bars so far. Well, I thought I had an example of what I want to show, but I am not remembering how I have it classified. This is what I'm talking about, a trend from the open bull trend and then a tight trading range for the remainder of the day. This is a trend resumption, trend reversal pattern. A lot of times you'll get the trading range and then the breakout up or down comes the next day. Still always in long. The bears are making money. They've made money selling above 13, tight trading range, but I still think it's easier, higher probability to make money looking to buy. Bears trying to get the reversal, but not a convincing top. You got a low 2, like a double top, low 12, low 16, both bull bars. Therefore, probably a tight trading range and not a bear trend. bears getting a reversal, I still think probably buyers around the moving average, around Friday's high, 50% pullback. But if we get one more bear bar here, especially a pretty good bear bar, then I think we will have reversed the rally. Do I think bear trend? Not yet. I still think trading range more likely than bear trend. Because the trading range is likely, can you buy the close, buy the market, buy the 50% pullback, buy the moving average? It's probably okay, but 17, 18, big enough surprise, probably first reversal up will fail. So not a high probability buy until after we get a micro double bottom. Why would somebody buy the close 18? Because most traders know the bears need to get 3 bear bars before traders believe the market is in the control of the bears. And a lot of bulls will buy the close of the second bear bar, betting that the bears will not get the 3rd bear bar. For stop entry bulls, 2 legs down, 1 pullback 2, failed bear breakout below 23, below 13, but probably sellers above and sideways. Limit order bulls who bought the 13 low made money. They bought the 18 close, made money. Now, bar 19 went below 18, but not below the low of the 18 bar range. So no significance. Second leg sideways to down likely, but similar to bar 1, a lot of bears will not sell above a bull bar if they think the market's still always in long. So that's a problem selling the 19 high. If you sell it, you probably need to stop above maybe the high of the day. But even if we go above the high of the day, probably sellers above. We've probably entered a trading range. Let me open up that examples PowerPoint. Trend from the open bull trend, tight trading range. Trend from the open bull trend, tight trading range. Too far, too fast. Trend from the open bull trend, tight trading range. Got trend resumption down later in the day. Trend resumption down later in the day. This is really not a trend from the open bull trend. Let me remove that. Well, I'll leave it because it's still the basic idea. Trend from the open bull trend, 3 bear bars to the moving average, still sideways. This is probably similar to what today will be like. At least for the next few hours at least. Minor reversal, no clear top, and therefore trading range more likely than bear trend. But once you've gone sideways for 20 or 30 bars, then the bears can start to get a credible major reversal. Lower high here. Now this is really not all that convincing. Lower high here, lower high here. Neither one is very good looking, yet the market totally reversed the rally. Even though we got the reversal, it came late in the day. Reversal, second half of the day. So probably we're not going to do much for the next couple of hours. However, if we start to quickly get down to the 8 low, then you're going to be thinking that we might go down to a new low of the day. Remember the weekly chart, I said last week, not a good buy signal bar, big tail below. I said this week probably would not be a big bull bar. That means either a small bull bar or a bear bar. and we have a small bull bar. If we go up 30, 40 points, there's an increased risk that we'll go back down and put a big tail on top after the big tail below here. Who's going to sell on a stop below 20? Lower high, minor reversal, possibly small second leg sideways to down after 17, 18, but probably not much down. So more likely buyers below 20, buyers below 18. %, pullback, a magnet. Friday's high, a magnet. The bottom of the buy climax, a magnet. So we have lots of reasons to come down here, but I think we'll probably go more sideways first. Because the tight trending range is likely, a lot of the bulls have switched to scalping, buying below things, buying the 20 low, buying the 18 close, and scalping. The bears are willing to sell, but probably not too low, because they think it's probably a trading range, which means it's probably going higher, maybe to the top of the sell climax, but probably not much higher. So if we start to get up here or above the high of the day, the bears will probably sell, looking for a scalp. Limit order trading. For the bulls, they have a high 2 with 13 and 19, but big tail, 2 bear bars, probably sellers above. For the bears, they have a pullback from the breakout below this bull flag, but consecutive bull bars, so buyers below. Right now, I think we're probably going to go sideways for another hour or two. The bulls want trend resumption up, the bears want trend reversal down. It looks like this kind of a day, trend from the open bull trend, trading range, trend from the open bull trend, trading range, late reversal down, trading range. It's very strong, rally on the open, sideways. I keep saying always in long because if we are going to get a breakout, it's more likely to be up than down. But I think most likely we're going to be in a tight trading range for at least another hour or two. By the close bull trend, disappointment bar 11, and therefore a lot of the bulls who bought 10 wanted to get out break even, and you can see they did on 14. When 14 went above the 10 close, a lot of the bulls sold, and that's in part what caused that reversal down. And then other bulls sold here, but I thought more likely buyers down here. Probably a trading range. We might try to get back up to the 10 close area. They sold it here, they sold it here. If we get near it, they'll probably sell it again. Every trend bar, every series of trend bars is a breakout and a climax. And this is a sell climax. Theoretically, bears have their stops above the 17 high, so it's a magnet. We might get up there, I'm not sure. With the bears, with the bulls selling that 10 close repeatedly here, it tells me the market thinks this is too high. Buy climax low, a magnet, just like a sell climax high is a magnet. 50% pullback, yesterday's high, also magnets. So we have several magnets below the market. For the bears, lower high, not really enough bars for a major reversal, so probably a minor reversal. Market simply looking for support. Moving average, 50% pullback, and yesterday's high here, so probably buyers somewhere in here. If we break strongly down here, and then we'll become always in short, and we'll probably get all the way back down to the open of the day. For the bulls, 20 gap bar buy, gap below the low of this bar, 20 bars with gaps. Often buyers at the moving average. Bears trying to get 2 or 3 consecutive bear bars, they want to reverse the day. Unlikely to be a big bull trend day. Daily chart looks like might be trying to form a wedge. 60-minute chart. We had a wedge, not a good sell signal bar. We got a bull breakout, and the breakout right now looks like it might be failing. But the bears need to get a big bear bar to reverse this bull bar, and the odds are against it, more likely sideways. Bears are hoping that this is an endless pullback from this rally, and the bulls are hoping that it's a high 2 or a wedge bull flag at the moving average, a breakout test of Friday's high. 3 pretty decent bear bars, especially 24. Limit order traders have been making money. Stop order traders, I would not sell below 15 or 23. So I think of it more as a limit order market. So that means it's probably not a very good buy with a stop above 25. 5 ticks above 24 close, limit order bulls made money. Bull flag, always in long, but I think not high enough probability for a scalp buy. 24 is big enough so that we may have to get a micro double bottom, 25 and maybe 28 or something over here. And for the bears, we're still always in long, and we're too far down to be selling, especially above a bull bar. So probably we'll go sideways for a few bars here. If you're a bear, you don't want to see 25. You don't want to see a bull bar after your bear breakout attempt. You had a gap, 24 close, 19 low, and it immediately reversed up. So this is a problem for the bears. They'll want to sell higher. Buy the low bull 16, got out when it got near the 16 low. Buy the low bulls 23, buy more lower. They'll probably try to get out around the 23 low. Consecutive bull bars, middle of a trading range. Bulls will probably scalp out. Is it high enough for the bears to sell the close? It probably is, but they still need to stop above the high of the day. And if they get stopped out, they'll sell again on a reversal down. Always in long, but odds favor continued trading range for at least another hour. Sell the close bears 26 made their 1 point scalp. It fell 5 ticks. Bears want double top lower high 23, break below the neckline 25, measure move down. Good enough reversal up 25, 26. Probably buyers below 27, 28, and more sideways, more limit order market. For the bulls, this is a bull flag, this is a breakout, this is a pullback. We're still always in long, but we're in the middle of a tight trading range. Therefore, buying the 28 high is only a swing, not a good scalp. For the bears, I would not sell above 28 because it's a pullback from the breakout of a bull flag. So bull flag, breakout, pullback, and we're still always in long. So I think the odds are the market's not going to go up a lot, but I'm not selling above a bull bar, above the moving average when we have a pullback from a breakout of a bull flag. So right now I'm trapped. I'll wait. I've been only scalping almost everything, limit orders. Now what about bears selling the 10 high, looking for a higher high, major trend reversal? Well, let's see what kind of follow through buying the bulls get on 31. I assume that there will be sellers above the 11 high, excuse me, the 10 high. It's a surprise breakout, so we'll probably get at least a small second leg up. So we're probably going at least a little higher. By the close again, I don't know how much upside. Excuse me. What about the bears who sold the 10 high they're trapped. It had to fall 5 ticks. It fell 4, reversed up. Part of the reason why 31 closed near its high is those bears who sold that high had a 4-tick trap, and as it started to go up, they bought back their shorts. About higher high, major trend reversal, tail breakout above a double top, 23, 26. 30, 31, strong enough, so probably at least a little follow through buying, so it's a low probability sell below 32. 60-minute chart, high 1 last hour, but a bear bar after a buy climax. Not a good looking buy setup. Probably sellers above last hour's high, which means probably sellers right around where we are. 5-minute chart, strong enough breakout 30, probably at least a small second leg up. So probably better for bears to wait for a micro double top. Limit order bears are sold 1 point above 10, probably will make money, either here or after one more push up. Stop order bears 32, I would not take that short. Micro double top, but I think not. I think the channel for the bull is too tight to be selling with a stop below 33, probably buyers below, and at least a little bit more up. Bull II, but 3 sideways bars. Always in long, but I think not a great looking buy above 34, unless you can put a stop down here and buy more lower. For the bears, 3rd leg up, 1, 2, and then possibly 3, but in general, I would not take that sell. We have a 7-bar bull micro channel, no bear bars in 5 bars, and we have a bull body 34. Probably buyers below 34. I'm not sure that there'll be enough buyers above 34 to make a scalp if you enter with a stop, but I'm not willing to take the short. 5-tick trap for the bulls who bought above 34, but that's not reason enough to sell. What about selling with a stop below 36 if it's a bear bar? I would not. This is a very tight bull channel. The probability of making money selling with stops is low. Limit order bears are sold 1 point above 34, made money. It had to drop 1 tick below the 34 high, which it did. Trading range, 20 or more bars into a bull trend here, about 80 bars into a bull trend. So trading range late in the bull trend usually becomes the final bull flag, which means we probably come back here either today or tomorrow. A lot of the bulls who bought the 30, 31 close scalped out and are waiting for a pullback to buy. Or they're waiting for it to go sideways and then possibly sell above a bear bar after it goes sideways. Bar 36, multiple of 12, end of the 3rd hour. Bulls trying to get a breakout above this pullback. This 1st hour was likely to get a second leg up after a pullback. This is that second leg up. We do not necessarily have to get a 3rd leg up. This is not a good looking buy signal bar, and therefore we might get sellers in the next hour. 5-minute chart, we're in a very tight bull channel, and therefore it's still by the close. No reason to sell yet. When the market is in a tight channel like that, even if it's parabolic and even if it's a possible parabolic wedge, 1, 2, 3, the probability of making money selling is small. We're trying to duplicate what we did last week, but the odds of that are small. This is what the bulls want. This is extremely rare to have a tight channel last this long. So if it's rare, it's also rare today. So it's unlikely to do that again today. Other kinds of measured moves based upon the height of this range. We're just about there right now. A little bit of room up there. And then leg one, leg two, leg one, leg two, far above the screen. Right now, I do not think we'll get there, but we might get to a measured move based upon the height of this range. Whenever it's impossible for the bears to make money like this, usually the market has to go higher to find sellers. So the downside risk is not great, even if we pull back. The market kept trying to reverse. Right now we look like this, but traders are going to buy the first reversal. The chance of it being a successful reversal is small without first going at least sideways. Doji, not a reason enough to sell, but probably going higher. This is JP Morgan. A couple of years ago, February 2016, this is what happened. A huge gap down. The news came out at the end of the day that Jamie Dimon, the CEO, bought $26 million worth of stock in his company on that day. Okay. So, here we have that huge sell-off, and we're in a sell-off here. We gap down, and the CEO buys $26 million worth of stock. There are many reasons to sell stock if you're a CEO. Maybe you want to buy a house, maybe you want to diversify, maybe, who knows what you want to do. Maybe you're trying to buy a second business, but there's really only one reason for a CEO to buy stock, and that's because he thinks the market is going up. So when Jamie Dimon bought $26 million of his company right here, you got to think that the guy believes the market's going up. Okay, so $52, $54, let's say $53 is where he bought it. This is where he bought it right here. And this is where it is right now. So in 2 years, his stock doubled. So, he made a good read of the market. This is Wynn, the casino company. Steve Wynn is the CEO. And somewhere in here, I don't remember exactly where, he announced that he bought, I think, like 70,000 shares. So that is a lot of stock, right? And he's the CEO. And if he's buying 70,000 shares, he has to believe the price is going up. So he probably bought it under $90. And it was announced, it made the news that he bought a huge amount of stock. So he bought his shares down here, and now the market is up here. The point is that if ever you hear on the news that the CEO of a company bought a really surprising amount of stock, especially if the market is selling off the way JP Morgan was selling off, and you hear the guy buys $26 million. $26 million does not sound like much, if you're a company, but he's not a company, he's a guy. And he bought $26 million worth of his company when the market was breaking to the downside in a bear trend. And, you got to bet that he's not an idiot, that he knows stuff that you don't know, and that all the other institutions that make recommendations on his company don't know. He knows something. So if ever you see that, you got to be thinking that maybe you should be buying the stock or buying calls or buying call spreads or something. Getting near the measured move based upon the tight trading range, but you still, the math is terrible for the bears. It's a small pullback bull trend. The biggest pullback is 6 ticks here. Makes it very difficult for the bears to make money. And that means it usually has to go higher to find a price where the bears will be willing to sell. Got to within a couple ticks of the target, and let's say we get a bear bar here. Can this be the high of the day? I think not likely. Probably it'll be like last week. And first bear bar, they'll buy it. And the best the bears can probably get is a tight trading range for a few bars. Suppose we reverse down sharply. Let's say we get a big bear bar. Well, then you got to be thinking, okay, spike, pullback channel. And if you pull back here and start to go sideways, maybe we'll get back down to the bottom of the channel, spike, and then pause and channel. But I think it's really hard to make money selling when the biggest pullback is 6 ticks. Let's say we get a bear inside bar, 40, and you sell above and scale in higher. That would be better for the bears, but it's still very difficult to make money when the pullbacks are 6 ticks or less. It does not matter what 40 looks like. Nobody's going to sell it. I certainly would not sell it. No one would sell below. They might sell above and start to scale in, but when the pullbacks are 6 ticks, I usually do not even sell above. Not a good looking buy for a stop above 40, but small pullback bull trend. The risks are small, and I'm not willing to sell until I see the bears starting to make money with limit orders. If they make money here, then maybe I'll start looking to sell again, but not right now. If this rally had 2 or 3 point pullbacks along the way, then I would be more willing to sell with a limit order at or a tick or so below that measured move. But no selling pressure on the way up, and therefore too early to sell for me. Limit order bears, I did not sell, but limit order bears made money selling the 40 high, so that's the first sign that we may start to go sideways. For the bears, they're hoping spike, pause, channel, and then we get all the way down here. Whenever you have a spike and channel pattern, the market often goes sideways about halfway down and then decides whether to resume up or reverse down to the bottom of the channel, which would close that gap above 10. This trading range probably will be the final bull flag. So I think we'll get back into it at some point today. 60-minute chart. We have a breakout, but bad follow through. So a bad looking high one buy. And we went up for 1 bar, but probably not going to go up much more. Biggest bull bar late in the bull trend, usually the final leg before we start to go sideways. We got a second leg up, but we probably will not get a third leg up. So probably not much more up today. This reversal is similar to this. This is a spike and channel pattern. Usually the market pulls back about halfway and then goes sideways. For the bears to start selling, for me to start thinking about selling, I'd like to see at least 3 bear bars closing on their lows. But even then, as long as we're still above the moving average, it's still probably a minor reversal leading to a trading range, possibly a trending trading range day, range, breakout, and upper range. Probable final flag, we're probably going back below the 10 high at some point today, but we're probably going to go sideways here. Can you buy the 43 high? I would not. I would wait for a second leg down. 42, 43, big enough so that we'll probably go at least a little lower. Well, the bull's a high one bull flag, but I think it's similar to this. The reversal down is strong enough so that we'll probably have to go sideways or down for another leg. Also, this is a spike in channel pattern, and usually the market goes sideways and tries to get down to the bottom of the channel, the beginning of the channel. So, low probability buy above 43. The limit order bulls, 41 low, probably will make money. So we'll probably get back above the 41 low either here or later. But big enough sell-off, probably sellers above 43 for a little bit more sideways to down. 60-minute chart, first hour good bar and then bad follow through. Third hour good bar, so far bad follow through. So sellers above, bulls probably will wait for at least a micro level bottom, something like this or like this before they buy again. Suppose 44 is a bull inside bar closing on its high. Will bears sell above it? They might, but probably only bears who can sell more higher. Bears would rather have the bar have a pretty big tail on top, like 18, like 19. They do not want it closing on its high, like 25. Limit order bulls above the 41 low and 1 point lower. Probably will take profits here. So we'll probably go sideways more. It's still always in long. Theoretically, the stop is all the way down here, but no one's going to risk that far. They'll get out if they see 3 bear bars or a single big bear bar. Can you sell the stop below 66 for a lower high? Well, it's not a major reversal. So if you're selling, it's better to be selling right where we are, 41 low, somewhere in there. I think it's probably better to instead look to buy a double bottom around the moving average. Bulls want to buy here or here, and bears want to sell here. Maybe a wedge, 1, 2, 3. Not a good looking buy, 50 high, not a good looking sell. Always in long, probability slightly favors the bulls. Some bears will sell around the 41 high, betting on a double top. Others will sell above, looking for a wedge top. If it forms a double top, even a lower high, it's still a type of a wedge. 3 rallies, 1, pull back 2, pull back 3. Sometimes the third leg up in a wedge does not go up here. I think I'm the only person on the planet who still calls it a wedge because it is a wedge. The forces are the same as for a wedge. It's just that the bulls were not strong enough to get the third leg to go above the second. For the bears, a lower high, minor reversal. This is not a particularly strong minor reversal, and therefore the odds of this being a major reversal are not particularly good. A major reversal usually follows a strong minor reversal. This is not a strong minor reversal, and therefore if we reverse again, it's still probably another minor reversal and a trading range. The bulls are mostly scalping. Buy the 41 low, buy more 1 point lower, or simply buy 1 point lower. Try to buy the 43 close, try to buy the 47 close or 47 low. They're less willing to buy with stops, although if they bought above 44, they got 6 ticks. That was exactly what they needed to get 1 point. And you can see we're stalling. Here, bulls did not scalp with 1 point. They held. Here, the bulls did not scalp for 1 point. They held. Here, it looks like they're scalping. So the bulls are getting less aggressive. So the bear is a double top, lower high, and a tight trading range. If the tight trading range lasts 10 or more bars like this, then it is an actual sell setup. It's better if the sell signal bar is a bear bar, 52 is not. It's better if 52, the second high, does not go above the first high. Tight trading range, double top, lower high, couple legs down. Strong rally, tight trading range, double top slightly below this high, two legs down. Second leg is usually bigger than the first. Tight trading range, lower high, so a double top, lower high, two legs down, one pullback, two. Tight trading range, here it's a higher high, but it's a tight trading range in a bull trend. Two legs down, one or one, and then two. Tight trading range with a double top, and it's exactly at this, so it's actually a big double top where the second top is also a double top. But anyway, I think of this as a double top, tight trading range, and a double top major trend reversal. Two legs down, here it went mostly sideways. Big bear bar at the moving average, so bulls bought it. It's another 20 gap bar buy, like 24. Stop order bulls buying above 54, always in long, but a tight trading range. Similar to 25, but I'm less willing to take that buy, so I did not take the 54 high buy, even though it's a double bottom. 43, 20 gap bar buy, always in long. It's the top of a tight trading range. In addition to a potential wedge, it's also a trending trading range day. Trading range, upper trading range. Right now, I still think there's a 60% chance we're going below the 10 high at some point today. This might be the start of it here. The bulls had a double bottom with 54, 43, and instead of buyers at the 54 high, there were sellers. It's a difficult short to sell at the bottom of the upper range. So I think it's difficult to do anything here. I'm still always in long, but right now probably buyers around the 10 high. We're at the bottom of the upper range. There are probably buyers right where we are here, 54 low, 43 low. But right now I am trapped out. I would not buy above 54 because it's the top of a trading range and we have a magnet below. And I did not sell because I do not like to sell at the high of a strong bull bar in a bull trend when the bull bar is at the moving average, like 25, 54. A tight trading range. You got slightly higher lows, slightly lower highs. You can call it a triangle. Bulls tried to break out above 57, but everyone is aware of the magnet back at the 10 high, especially since we reached a measured move target. And therefore, a lot of bulls do not want to buy here. They want to buy lower. Since we're still always in long, and since the reversal down 53 has had terrible follow-through, most traders do not want to sell yet. The odds still favor the bulls, but every bar that gets added increases the chances that we're going down to the 10 high. A quick sell the market in there. As it started to go down, everyone concluded it was going to get back below the 10 high. Tells you that the bears are sold, scalped. The bulls are trying to keep the gap open. Remember, 60% chance when you have trending trading ranges. You dip at least one tick below the top of the lower range, the 10 high. Bulls are trying to keep the gap open, but we've already reached a measured move based upon this lower range, and that reduces the probability that this gap is going to stay open. It's possible that we'll get a measured move from the low to the gap, but it's probably not enough time to get all the way up there. way up here. I don't think that's going to happen. The bears, they're hoping it's like 24.25, a failed reversal, but this time it's different. We're reasonably close to the measured move target, and I still think we're going to get there. And that means I think no matter what 60 looks like, a lot of bulls are not going to buy above it. Will the bears sell the 60 high? Not if it closes on its high or has only a one-tick tail on top. This is the end of the 5th hour. It was likely to not be a big bull bar. That 3rd hour was follow through after the 1st hour. We were likely to get a second leg up. And after the 1st hour, we had bad follow through. After the 3rd hour, likely to have bad follow through. So what do you do with 60? Well, we're still always in long. Might be a gap bar, might be a gap between the high of the bar and the moving average. But and we clearly have a gap, 59 low and 10 high. But I still think the odds are we're going to get down below the 10 high. I'll change my mind if 60 closes on its high and if 61 goes a couple ticks above 59. I don't think the probability is high enough for a buy scalp above 60, but it's a moving average gap bar. We have a gap below the moving average. We're clearly always in long. So it's an okay swing. However, we have a tight trading range here, which is a magnet, and it'll be difficult for the bulls to get much beyond that tight trading range. So there's not all that much upside. Probability not high enough for a scalp buy. And for the bears, it's too good of a bull bar, and the context is too good to sell above 60. You can always take one of those low risk shorts. You sell at the market here and put a stop 1 or 2 ticks above 60. Take a chance that the bulls will not trigger the reversal up. Whenever you take a low risk trade like that, risking a couple ticks, the odds are you're going to lose money. Whenever the risk is low, the probability is low as well. Right now, I'm on the sidelines. I took a quick scalp, and I'm flat. The bulls need more than 1 or 2 ticks, right? Too much risk of a trap. The bears hope 60 and 61 are forming a pullback in a bear breakout. The opposite of this, here we have a bull breakout. And instead of a reversal, a pullback and a bull trend was more likely. The bears are hoping that instead of this being a reversal, it's simply a pullback from this breakout. But that's a bad looking bar for the bears, bar 60, closing on its high. I think difficult to do anything here. You can be swinging along, and for the bears, I think we're still always in long, so I would not be swinging a short. And to scalp, it's too low in the beginning channel to be selling, so I can't sell. And for the bulls, big enough 59 and magnet below, I'd rather buy a double bottom. Once it goes 2 or 3 ticks above that bull bar, the probability for the bears drops off quite a bit. The bears need to trap bulls, and No, they wanted to go a tick or two above, not 3 or 4 ticks above. Back into the upper range. The bulls obviously want our break above the upper range, but I'm not sure that they'll be successful. The market was sideways here for over 2 hours. That means that a lot of traders believe this is just about the right price, and therefore if the market gets below it, it gets back up to it. If it gets above it, it probably gets back down to it as well. Pretty good reversal up, but I'm not going to buy up here. We're in the middle of this range. I might buy a pullback, but I'm not buying at the market. If we break strongly above it, I might buy for a scalp if we get something like this again, or like this. Not quite big enough to make me buy it, so I'm going to wait. We'll probably get a pullback similar to after 44, 45. Can you sell it betting on a pullback like after 44, 45 and like after 25, 26? I would not. The bears had their chance. They had to get below the 10 high, unable, and therefore the bull trend is trying to resume. The bulls would like a measuring gap, but we're not going up fast enough to reach a measured move from the low of the day to the gap. And we've already reached a measured move based upon the 10 high. So I think we're going to have a hard time going much above the high of the day if we go above the high of the day. For the bears, it's still a channel. We have a lower low and we have a lower high and possibly another lower high. But more likely, we'll get up to the 53 high and the bears will try to get a double top lower high. Double top lower high in a tight range. I doubt we're going to get a reversal, another double top lower high in a tight range. Another lower high, but 6 bars up without a bear body. More likely a pullback in this breakout. Bull flag here or bull flag here, bear channel, bull flag. However, I think we're going to have a hard time going much above or below where we are. We're back into a tight trading range where the market was for over 2 hours, and that's a pretty strong magnet. For the bears, another attempt at a lower high major trend reversal, but with a 6-bar bull micro channel. This is more likely a minor reversal and will probably go sideways. Bulls bought the 65 low, 1 point lower, the moving average, a 50% pullback of this rally. But will they buy with a stop above 67? I don't think the probability is high enough for scalpers. They might buy for a swing. However, you have to bet we're going to have a hard time breaking free of this tight trading range. The market has agreed for 3 hours now that this price is just about right. Limit order bulls who bought 1 point below 65 just made their money. We went 1 tick above the 65 low. So you'll have some bulls selling here, scalping out of it once. At bull bar 45, bulls who bought here lost money. Bulls who bought above 51, bulls who bought above 54. Not a very strong buy. We're still always in long. You can buy it for a swing, but the odds are it's not going to go up very far. We're at the top of a tight range. Ledge, 4 bars, same price. Odds are we're going above it either today or tomorrow. However, when you have a ledge and the market goes above it, usually it comes back at least a little bit below it. It usually pulls back a little bit below it. So if we go above it, we'll probably dip back below it within a few bars. If instead we break strongly above it, then we'll probably dip back below it tomorrow. The reason we're not going up is too many traders want to sell higher. And you can see what happens when we went down. It could only go down briefly because bulls wanted to buy below the range, bears want to sell above the range. It starts to go up, bulls start to take profits and look to buy lower. Also, bears start to short and sell more higher. And the opposite is true down here. The bears who were short buy back their shorts, thinking that we're not going to go very far. And the bulls start to buy and scale in lower, betting that a bear breakout is more likely to reverse and lead to a bear trend. And the result is the market keeps getting drawn back into the tight trading range. Bulls and bears buy low, bulls and bears sell high. Bears sell high to put a position on, bulls sell high to take it off, and the opposite is true at the bottom. The bears a micro double top and a bigger double top, lower high 52. So a lower high, major trend reversal, second entry sell, but I think still too tight a bull channel, low probability sell, probably buyers below. Bulls might try to get a double bottom, 67, and then try to close on the high. Ledge top should go above. Sometimes you go above for just 2 or 3 bars and then pull back. Ledge bottom went below for a few bars, but immediately pulled back into the ledge. Ledge top went above briefly, pulled back into the ledge, got a reversal down. Ledge bottom went below, but pulled back above. So probably this kind of behavior. So if we break out to the upside, we'll probably pull back. Not necessarily on the same bar, but probably within a few bars. Here, it took about 10 bars to get back into the tight range. If we do not go above the ledge today, we'll probably go above it tomorrow. Ledge did not get above it today, sold off strongly the next day, but still got back above the ledge. Ledge could not get above it, sold off, got back above it the next day. Here's a ledge. Here's the close-up of it. 9 bars. Could not get above it. We sold off. Went above it a week later. And then once above it, we pulled back below the top again. Will the bears swing, sell below? Will the bulls swing, sell above? But more likely, we're going to stay pretty much in this tight trading range for the remainder of the day. Higher probability, wait to see if we start to sell strongly, then sell, or wait to see if we break out strongly like this and then buy.
Bear trap, late attempted bear reversal, fail, and we're trying to resume up. Sell off late in the day, bulls bought it. Profit taking, sell off late in the day, bulls bought it. Bears trying to get a reversal, bulls bought it. Small one here, but the same idea. Bears trying to get a late reversal, bulls bought it. That's the minimum objective, getting one tick above the top of the ledge. We might go up for a measured move. Remember, when you have a ledge and a breakout, usually you get a pullback back into the ledge. So the upside here is probably not very big. If we go up 2 or 3 bars and get a reversal, it would be the opposite of this. This was a potential failed breakout and a buy. If we go up for 2 or 3 bars and get a bear bar, that would be a potential sell or move back into the ledge, back into the tight trading range. Some sellers at 41 high, other sellers 4 ticks above 70, which is at the 41 high. Other bears will wait to see if we go up 2 or 3 bars and then get a bear bar and then sell. We might run out of time. Break out below, reverse up, pick out above, reverse down. Stop entry bears made money here. Stop entry bulls made money here. Third push up on the day, even though not a wedge shape, it's a type of wedge. 1, 2, 3. 5 tick trap for the bulls. They'll probably get out below 71. For the bears, not a good sell signal bar. The limit order bears who sold the 41 high wanted to dip 1 tick. They needed to fall 5 ticks, which would be 1 tick below the top of the ledge. I am currently flat. I debated selling 1 point above, and I chose not to do it. Still always in long, but the bulls will be fairly quick to get out on a reversal down. Breakout pullback buy, but not a lot of bulls willing to buy with a stop above the top of a small doji bar at the top of a small trading range. And for the bears, it's a very tight channel. Not a lot of bears willing to sell with a stop. Getting late in the day, so not great for selling with limit orders either. So if the bears are lucky, they'll get a pretty good reversal bar. If the bulls are lucky, we'll get a buy the close bull trend. One of the problems for the bulls is a buy the close bull trend might be beginning a little early. So this is unlikely to make it to the end of the day. Buy the close bull trend, if it starts too early, has a hard time making it to the end of the day. This one started late enough. You can see it goes up 5 or 6 bars and then stops going up. Here are some examples of buy the close starting too early. Very big reversal down. Same here, starting 12:05. Today's starting 12:15. very strong bull day, but still could not make it to the end of the day. Suppose we get an IOI. Well, if it's a bull bar, technically it's a buy, but this is a weak rally at the top of a tight trading range. If it's a bear bar closing on its low, it would probably be an okay sell looking for a couple points down. But as I said, I thought we probably would not go very far up or down here. Not a very good buy, right? The bears achieved their goal. We fell one tick back below the top of the ledge and traders bought it. For the bears, I would consider a sell, but I would want the bar to be perfect. 2 or 3 tick body closing on its low. Well, it's probably not going to go up much higher. It's too late in the day to be selling with limit orders in a tight bull channel. And for the bulls, I think it's a tough buy. Twice today we had surprise bars 8 and 30. The bulls are hoping to get that again here. What's different here is this is the 7th bar in a buy the close rally, and that is a lot. Buy the close bulls should get out 4 ticks below any bar and 1 tick below a bear bar. This is too many bars, so I think it's risky to do anything here. The bulls could argue that it's only becoming by the close here, but I think it's already by the close. I'm letting it go because too many bars. Risk can happen fast at the end of the day. Like this, you can get a huge bear bar erasing all of the prior by the close bars. Similar to today, a lot of tight trading range by the close. Earlier in the day, I said it probably didn't have enough momentum to make a major move up from the low of the day to the top of this bar, this gap here, but that is not the case now. It's not that far to that target. I'm going to let it go. I don't want to take the risk of the big reversal. Bulls have to get out of longs, I think. 1 tick below a bear bar, 3 or 4 ticks below a bull bar. Bears might take the sell, arguing a wedge, but we still have room to the target in the top of the channel, so not a great stop entry sell. However, there's a risk of a risk happens fast type finish because this by the close started too soon. That's a questionable exit. If it closed on its low, I would definitely get out. 1 tick bear body. Sometimes it goes 1 tick below and then suddenly outside up. But I personally would get out of longs there. And I had my finger on the button to sell, but I wanted the bar to close on its low, and I wanted at least a 2 to 3 tick bear body. Did not get that. Parabolic wedge at this point, but I think he cannot sell. Even no matter what the bar looks like, I would not sell. We finally got the target, which I did not think we were going to reach because the market was so quiet for so many hours. But it was like what we had over here. The market was so quiet for hours, it still rallied at the end of the day. Weekly chart, I think this is pretty interesting. We have a big tail on the bottom of last week. We have a buy climax here. And a lot of times if the market's going to transition into a trading range, you'll have a big tail on the bottom of one week and then a big tail on the top of the other week. To get a big tail on the top of the other week, you need a rally and then a reversal. So we might get that this week. Alternatively, this week could be another big bull bar like these, but if it does become another big bull bar, I think that probably would be the end of the rally. When you have a buy climax, sometimes you get a pause and then one more buy climax, and then the market enters a trading range, which I think is likely. The market, it's never been, this is a weekly chart, it's never been this overbought in history. Monthly chart, crazy bullish, right? It's never been this overbought in history. I forgot how many months now. It's like 15 months without a pullback. That's never happened in the 100 years of the stock market. And now we're getting the biggest bull bar late in the bull trend. So probably a climactic end. But climactic end of a bull trend does not mean the start of a bear trend. It just means the bull trend pauses. Traders are going to buy the first reversal down, even if it's big, even if it's 5%, even if it's 10%, they're going to buy it. This is very, very eager bulls. Yes, if we start to get a sharp reversal, weak bulls will panic out, but strong bulls will buy 5, 10, even 20% down. There's not much downside risk. And even if we were to sell off all the way down here, we would get such a sharp rally that the buy the close bulls here who bought more lower would be able to avoid a loss and probably make a profit. 5-minute chart began quietly, just like Friday was fairly quiet. And first part of the day, a bull bar closing below its high. We had a wedge top on Friday, 1, 2, 3. Odds were we would have a couple legs sideways to down, and we did not get it. Some computers might say 2 was down. I think of it as more 1 leg down. We broke above the wedge. The bears tried to reverse. They tried to get a failed breakout above the wedge. Instead, we got a big bull bar 8, and that made it likely that we were going to get at least 2 legs up. 1 pullback, maybe 2, but the channel up was so tight, probably the best the bears were going to get is a trading range. It was possible that the trading range lasted all day. Lasted about an hour or so. We got another breakout. Relatively surprisingly, a big bar, follow-through bar, probably going higher. Very tight micro channel. Might test to the beginning of the channel, which we did. I thought we were going to test 1 tick below the 10 high, maybe more, because it was a trending trading range day at that point, and the reversal down, instead of testing below the 10 high, it became a breakout test. The gap remained open, and I thought we might simply go for a measured move up based upon the height of this range, which we did. Instead, we went to a measured move up from the low of the day to the gap up here. So really impressive rally. This was one of those late bear traps that sometimes happen in a bull trend day. The bears get a pretty impressive bear bar, but instead of follow through selling, we get a reversal. It does not look like much when it happens, but it very often, probably most of the time, it goes to a new high. Rarely does it go up like this. This is just part of the blow off top that we have going on with weekly and monthly charts. The market just keeps going up and up and up and up. Wedge rally Friday, and then breakout here. Trading range, 2 legs down, 1 pullback, 2. Another breakout, strong rally. Probably bulls will buy the first pullback, but they might want 2 legs down because this is climactic. 1, 2, and then we started to work higher, and then it became strongly by the close, and then outside up. Sometimes, as I said, when you have a buy the close finish and you get a reversal down, even with the bear bar, it's just not strong enough. And instead of sellers below, there are buyers below, and you get outside up. And traders buy on a stop above the high of that sell signal bar for a couple points up. For stop entries today, you really had to wait a while for something obvious and easy. We have a double bottom 76 and 1, not a particularly good buy. But once we got bar 8 and especially 9, the market was always in long. Bar 12, possibly sellers above, but I think it's always in long. We have an II, unlikely that it's going to be the high of the day. Even if we pull back deeply back below yesterday's high, we probably will come back up to that 10 close. By the close bulls, disappointed, 12, 13, 14, you can see they sold when it got back to the 10 close, and we got a couple legs down. But a 20 gap bar buy, bulls bought it. I'm not opposed to buying above 12 if you put a stop down here and if you trade small. I would not buy above 19 after the 2 bear bars. Chances are the bulls would need some kind of a double bottom, which they got 25. 25, we're in a tight range, certainly an okay buy for a swing, but a lot of bulls will scalp. And then we have a surprise 30, 31, probably going higher. So buyers buying closes, buying above bars, buying below bars. Stop entry bulls, maybe above 34. 44, we have two decent bear bars. I thought we would get a second leg sideways to down. You can buy above 44, 48, 50, 54, 60, any of those bars if you trade small and use the correct stop. Too much risk of another trading range. Not much risk of a reversal. We had a double top, lower high major trend reversal here, but a higher high, 52 above the first high of the double top, and not a good sell signal bar. That makes this much more likely a minor reversal and not the start of a bear trend. Stop entry bulls again above 60, and then above 70, and then above everything, 72, 74. We have 5, 6, 7 bull bars, and then we broke strongly to the upside, 76. The bears were hoping exhaustion bar and a reversal down, but they only got a one tick bear body on 77, and bulls bought the low, and they bought the high of 77 on stop. Buy the close, 7, sell the close. 8, I thought was a surprise bar. Probably buy the close. 8, 9, 10, buy the close. 11, buy the close, but you need the appropriate stop. 30, another surprise bar. Buy the close. 30, 31, all the way up. Even up here, still buy the close, because the odds are, even if we reverse, the first reversal will be minor. Bulls have bought the 39 close, got out over here. All right, disappointed by this, thinking we may pull back below the 10 high, did not. And then buy the close up here, maybe by the 4th, 5th, or 6th bar, clearly by 75, 76 by the close. Limit order traders, bar 7, the bears wanted a failed breakout above the wedge, but 6 bar bull micro channel, buyers below 7, buyers below 12, buyers below 16. It's a second entry short, failed breakout yesterday's high, but a bull body. Probably buyers below 22, and buyers below 27. We have a breakout of a high 2 bull flag here, so probably buyers below, and buyers below everything, buyers below 41, all through here, but you need a wide stop. 6 bars up here, probably buyers below 68, although it's an okay swing short for a double top, lower high, major trend reversal, double top here, second entry short, but tight bull channel, more likely minor reversal, and we'll go at least a little higher. Buy the close, sell the close. Clearly 8, 9, 10, buy the close. I said 18 and 24. Bulls would buy the close because this was unlikely to be a top minor reversal. This is the second leg down, more likely a 20 gap bar buy and 2 legs down, 1 pullback 2. And the same with 59. It was a quick scalp if you were fast, but it looks like more bulls bought the close of 59 than bears selling the close. No sign of a top. We just keep going up and up and up. Really, really extreme. Whenever the market is in a blow-off top like this, it can go up a long, long way. And when it corrects, it usually enters a trading range for a lot of bars. So this is the weekly chart. I'm assuming the trading range will last at least 10 bars, like this. So at least 2 or 3 months. But this is so strongly up. Any sell-off, even down to the bottom of the final buy climax, will probably be a bull flag and not a bear trend. Question, do you consider 54, 55, 56 as a small ledge? It's a ledge bottom. We have 4 bars here, 57. So that is a ledge. Anytime I see, maybe 3, usually 4 or more bars exactly at the same low or exactly at the same high, I think of it as a ledge. And therefore, I think you'll get a bear breakout below the ledge bottom and reversal back up into the ledge. And here, I expect a bull breakout above the ledge and a pullback back below the top of the ledge. And whatever happens after those 2 things, anything can happen, but those are the 2 things that typically happen. Okay, if you consider these 4 bars to be a ledge, can you sell the 57 high looking for a breakout below the ledge? Sometimes I'll do that, but with this market as strong as it was, I did not want to sell that low below the high. So if you did, obviously in this particular case, you made money. but you need more than probability. The probability is you make money, but will you make more money than what you're risking? And that's the problem with selling in a bull trend. Very often there's a high probability of you making money selling, but it's still a bad trade if the actual risk is bigger than the reward. Okay, question. I heard someone say parabolic climaxes do not end in sideways trading. They're wrong. Okay. They're talking about climactic reversals. If you want to call it, after you see the reversal, like Bitcoin, right? If you want to look at Bitcoin and say, well, that's a climax top. Here's Bitcoin cash index. You can say that's a climax top, and it led to a reversal. But it also went sideways first. Usually, when you have any kind of a strong blow off top like this, Bitcoin is an example. It usually, you usually get a sharp reversal down and then a trading range, and then the market decides whether to resume up or to reverse down. Here's an example where it reversed down. NVIDIA was an example last year. Actually, they had several examples of it. Okay, so here we got a blow off top in NVIDIA, and it's a climax top, a climactic reversal, whatever you want to call it. And a climactic top, a blow off top, means the top is ending. It doesn't mean a bear trend is beginning. It means the bull trend is ending. And that leaves one other thing, and that's a trading range. And after it's gone sideways for 10 bars, traders decide, are you going to get a reversal down or are you going to get trend resumption up? Okay. This is what usually happens after climax, by climaxes. You get a sharp reversal down and then a trading range, and then the market decides whether you're going to get a major trend reversal down or a double bottom bull flag and a bull trend resumption up. We got a couple legs down here. Trading range. And then we got another reversal up, another big buy climax, another reversal, trading range, double bottom. Market didn't care. It kept going up. So most blow off tops result in trading ranges, and then the market decides whether to get a reversal. It's rare for a market to do the Bitcoin thing. Riot is another example. A thinly traded stock. Okay. Buy climax, reversed trading range. Buy climax, reversed. Buy climax, finally a reversal, but probably a big trading range and not a total reversal of everything. But this is what typically is going to happen. The 87 stock market crash is extreme. The 1929 stock market crash is extreme. Those are rare. That's 2 in the past 90 years, right? More likely, market is always having buy climax tops and buy climax bottoms, and most of the time they do not lead to a reversal until they first go sideways. A climax is big up, big down, big confusion, usually has to go sideways. Like in the example that I showed with NVIDIA. And that's probably what's going to happen here. We have big up now. We're probably going to get big down, and then big confusion and sideways. A little bit of it here, big up, big down, confusion, and sideways. We see it all the time here. Big up, big down, confusion, and sideways. We see it all the time on the 5-minute chart. Sell climax, reversal up, trading range. Had to go sideways through double bottom before the bulls could get a reversal into a bull trend. Even then, it simply tested the sell climax high. Buy climax, climactic reversal, trading range. One other thought about that question. The question was, do climactic reversals always lead to bear trends. And anytime anyone says always, the person is just ignorant. That doesn't mean they have a low IQ. It just means they don't know enough about how markets behave. To say something silly like that, never and always, that implies you own a golden goose, that you can take a trade and you're confident 100% that you're going to make money. Rarely ever is anything more than 60%. That means even the world's greatest looking buy climax, only at best 60% chance it's going to lead to a reversal. And that's the case here. In this case, weekly chart, monthly chart, 60% chance, 70% chance. If we get a big climactic reversal down, it's only going to lead to a trading range or resumption of the bull trend. My guess is at this point, if we get a climactic sell-off, maybe only 30% chance it's going to lead to a crash type of reversal, like what I showed you with Bitcoin and Riot. So without the market going at least sideways for a few bars and getting a micro double top, the risk of an immediate reversal into a bear trend, probably 20%, 30%. However, if it goes sideways for a few weeks and gets a micro double top, then the risk may go up to 30, maybe even 40% if it starts to reverse down. But right now, very little risk. Okay, no sign of a top, it just keeps going up and up and up. Increased risk of a doji bar on the weekly chart because we had the tail on the bottom last week, so increased risk of a tail on top this week. If we do not get a reversal this week, then increased risk of a 2-bar reversal up this week, down next week. Buy climax, consecutive buy climax. Probably going to start to enter a trading range soon. Okay, hope everybody has a good night.